the world watches rising military tensions in the Middle East, a quieter story is unfolding in global energy markets. Saudi Arabian oil exports have suddenly surged to their highest level in 3 years, reaching roughly 7.3 million barrels per day. At first glance, this looks like a routine shift in supply, a temporary increase driven by market demand. But the timing raises a deeper question. Why would the world's largest oil exporter flood global markets at the exact moment geopolitical tensions around the Persian Gulf are intensifying? The answer may lie in one of the most vulnerable choke points in the global economy: the Strait of Hormuz, a narrow stretch of water connecting the Persian Gulf to the open ocean, and one of the most critical energy corridors on Earth. Roughly 20% of the world's oil supply passes through this passage every single day. And if a conflict between the United States and Iran were to erupt, this choke point could become the center of a global energy crisis, which means the recent surge in Saudi exports may not simply be about markets. It may be about insurance, an insurance policy written in crude oil. To understand why, we need to look at how oil moves through the Middle East, and how countries like Saudi Arabia are quietly preparing for the possibility that one of the world's most important shipping routes could suddenly become unusable. The Strait of Hormuz is only about 21 miles wide at its narrowest point. But despite its size, it carries one of the largest concentrations of energy trade in the world. Every day, millions of barrels of oil leave the Persian Gulf through this corridor. Tankers from Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, and Iran all pass through this route on their way to Asia, Europe, and beyond. If this corridor were disrupted, the consequences would be immediate. This is why the strait has long been considered one of the most strategically sensitive locations in global energy markets, and why governments across the region have spent decades preparing contingency plans. Because the reality is simple. A single choke point should never control the flow of the world's most important commodity. Saudi Arabia's contingency planning does not rely solely on tanker routes. For decades, the kingdom has invested in an alternative export system designed specifically to bypass the Strait of Hormuz. This system is known as the East-West Pipeline, often referred to as Petroline. Stretching roughly 200 kilometers across the Saudi desert, the pipeline connects oil fields in the eastern part of the country to export terminals on the Red Sea. This means oil can reach global markets without ever entering the Persian Gulf. If the Strait of Hormuz were blocked, tankers could still load crude at the Red Sea port of Yanbu and sail directly toward Europe and global markets. In strategic terms, this pipeline acts as a pressure release valve for Saudi oil exports. Even Petroline has limits. Its capacity is only a fraction of total Gulf export volumes, which means that in the event of a prolonged disruption, global supply would still face severe constraints. That is why countries across the region are not relying on a single solution. They are combining pipelines, storage strategies, and accelerated exports to reduce risk. In financial markets, insurance often takes the form of derivatives or contracts. But in the oil market, insurance looks different. It looks like inventory. Barrels stored in strategic reserves. The cargo was already delivered. The tankers are already moving. By increasing exports now, producers allow importing countries to build inventories before any disruption occurs. These reserves act as buffers. If a crisis temporarily cuts supply, stored oil can fill the gap. Energy security becomes a matter of timing. Ship today, store tomorrow, stabilize markets later. This approach reduces the shock that sudden disruptions would otherwise cause. But it also reveals something important. Energy markets do not simply react to crises. They anticipate them. The Persian Gulf has long been one of the most militarized energy corridors in the world. Naval patrols from the United States and allied countries regularly monitor shipping routes through the Strait of Hormuz. Iran, meanwhile, maintains its own presence in the region. Periodic confrontations, drone incidents, and tanker seizures have occurred over the years. Most of these incidents remain limited, but the underlying risk remains constant. Any escalation could quickly transform the strait from a commercial highway into a geopolitical flashpoint. Energy markets understand this. Oil traders do not wait for war to begin before adjusting positions. They price risk early. Shipping companies monitor insurance costs. Producers evaluate alternative routes. And governments coordinate emergency reserves. In other words, preparation begins long before the first shot is fired. The surge in Saudi oil exports may appear sudden, but in reality it reflects a broader strategy. one built around risk management, energy security, and geopolitical uncertainty. By accelerating exports while shipping lanes remain open, producers reduce the amount of oil exposed to potential disruption. By strengthening pipeline alternatives, they create backup routes for global supply. And by allowing buyers to build inventories now, they soften the impact of any future shock. This is not panic. It is preparation. In the world of energy, crises rarely appear without warning. Signals emerge first. Production shifts. Shipping patterns change. Inventory levels rise. These are the quiet adjustments that occur before markets fully understand what may be coming. And right now, the Persian Gulf is sending one of those signals. Because if the Strait of Hormuz were ever closed, even briefly, the consequences would ripple across the entire global economy. Energy prices would surge, trade routes would shift, and the strategic value of every pipeline, port, and tanker fleet would suddenly multiply. For now, the corridor remains open. Ships continue to pass through. Oil continues to flow. But behind the scenes, the region's largest producers are already preparing for a different scenario. Moving crudely, building reserves, securing alternative routes, writing their insurance policy one barrel at a time.